Thank you, everyone, for joining us today to learn about the personal pension plan. My name is Viren Parmar. I'm an independent financial advisor operating through my company, Karma Financial. I've been helping business owners and individuals for over 10 years in terms of investment planning, tax and estate planning, as well as insurance solutions. My background includes accounting, finance, tax, as well as the personal pension plan, which has been a recent phenomenon. And we are joined today by a very special guest who will talk to you about the personal pension plan. For those of you who don't know, personal pension plan is a great tax savings and retirement planning tool for small business owners. We are joined today by Jean-Pierre Laporte from INTEGRIS Pension Management, and he has been working as a pension lawyer for over 10 years. He won the Diamond Jubilee Award in 2012. Jean-Pierre, take it away.
Thank you, Viren. So, everyone, welcome to this session on personal pension plans, hosted by Karma Financial. So today we want to ask some very fundamental questions, and we've stated them here on the screen. Do I want to pay less tax than 98% of Canadians who are using RRSPs? Do I want to maximize my retirement income and have the largest possible nest egg in retirement? And do I want the tax refunds that are generated by this plan to pay for the costs of the program instead of it having to come out of my own pocket? So if you answer yes to these three questions, then this is a very important session. Why? Because the personal pension plan is the most tax-effective registered pension plan solution allowed under the Income Tax Act. It allows you to put more money to grow over time than all the other alternatives like the tax-free savings account, the RRSP, and even the individual pension plan. So to better understand how a personal pension plan works and what it can mean for you and your business, we are using a case study here of a doctor that's in mid-40s. So it's a male that's 45 and who's content with a rate of return of 5% on assets. The Medical Professional Corporation pays this doctor salaries or bonuses not exceeding $150,000 a year. The rest could be retained earnings or dividends. This medical corporation was incorporated back in 2010. And to date, this doctor has been able to stash away about $450,000 in an RRSP. The doctor wishes to retire at age 65. So based on these assumptions, what we've done is we've produced an illustration, and this is what you would be getting as a potential client. And the first thing we look at is how much more money can I contribute inside the PPP above and beyond the maximum that I would be allowed to contribute had I done an RRSP instead. And in this case, for this 45-year-old doctor retiring 20 years later at age 65, the answer is $484,000. This is what we call gravy, extra contributions above and beyond what you could have contributed had you maxed out your RRSP every year. So we're pushing close to $500,000 of additional tax assistance for this doctor. But of course, if you are earning 5% on those extra contributions, what does that yield? Well, the answer is $779,000 and change. So we're able to generate $750,000 more in terms of additional monies above and beyond what you could have earned inside of your RRSP had you maxed out your RRSP every year. So that's it's a pretty significant upgrade. Again, it's important to remember that whether or not you're using an RRSP or a PPP, we've assumed that the assets are only growing at 5%. So to generate this $750,000 more, we haven't taken extra market risks. Well, the question is, where does this extra money come from? Why is the law allowing this doctor who sets up a PPP to put $484,000 more than the same person using an RRSP? Well, it breaks down into different categories. So we have the fact that because he incorporated back in 2010, he has 10 years of past service. And to fund that, the medical professional corporation would be contributing $52,000 in change. Then every year, because pension legislation is more generous than RSP legislation, we can put incremental additional amounts, and when you add them up over 20 years, that's another $315,000 in change that the doctor, or the company, I should say, is able to put in the pension plan and claim deductions for. The PPP also allows you to do some additional personal deductions. So in this case, there's about close to $19,000 of personal tax deductions, contributions that can be made by the doctor directly. And finally, remember that one of the assumptions that we had stated was that he's happy with a 5% rate of return. Well, under the pension rules, the plan should normally be growing at 7.5%. So since he's not hitting the 7.5% hurdle rate, what that means is that the corporation can do additional tax deductible special payments, here almost $100,000, that can be put into the plan to backfill it just because we weren't able to grow the money as quickly as we were hoping to. So we're creating extra tax deduction room. So that's pretty good, but the question now becomes, are there any other tax advantages that are unique to pensions that you will not get if you use an RRSP? And the answer is yes. So the first one is that all the investment management fees are tax deductible to the business, something you cannot do with an RRSP. So here, just for ease of calculation, we've assumed that Karma Financial is charging an investment management fee, or IMF, of 1% of assets. And we've used the example, the data from this particular doctor, and we've calculated what 1% of the assets look like in terms of fees that's deductible by the company. Since the company is taxed at 15% corporately, that means the company is saving on taxes every year. So the last column on the right shows all of the taxes saved by the company. And you tally it up over the 20 years, and you can see that being able to write off the investment management fees means that the company has saved $47,000 in taxes that they won't have to remit to CRA. Well, that 47,882 number is important because on the next slide, we can see in a worst case scenario, meaning if we're using the most expensive PPP platform, the fee would be 48,600. But because we were able to deduct the investment management fees and claim a credit for those, the real cost over 20 years of the entire product is $718. And if we divide that by 20 years, it works out to about $45 a year. I mean, that's the cost of a meal at McDonald's with a family of two or three. And what does that $45 a year give you? It gives you $779,000 of additional money. So $750,000 more to retire on. But that's not even the end of the story, because there are other massive tax deductions and tax savings that come with this product. So one of them is if you shift to a pension income stream sooner than age 65, there are other extra deductions that are permissible. So let's look through this example here. Initially, when we looked at the facts, I told you that he wanted to retire at age 65. Now, if he retired at 65, this doctor would have an annual basic pension of $175,540. And you see that in the white column called basic pension at age 65. However, if this doctor decided to retire at 62 instead of 65, which is perfectly acceptable, then what happens is that instead of that pension of 123, instead of 175, he would be entitled to a pension of 123,601. That's the basic pension at that age, at age 62. But if we do terminal funding, which is if the medical professional corporation injects $575,000 into the pension plan, thereby creating a corporate tax deduction for the business, then what happens is that instead of $123,000 a year, this doctor can now retire on a pension of $169,000 a year. So it's a nice little upgrade. And what we've done is we've enhanced the basic pension with an additional pension and a temporary pension. And those additional streams of pensions are funded by this terminal funding amount. So that's a nice little upgrade. But that's not even the end of the story, because remember, now this doctor is enjoying an annual pension at age 62 of $169,000. That pension can be income split. Now, if he doesn't do income splitting, in Ontario right now, he'd be paying about $54,000, almost $55,000 in taxes personally on that annual pension. But because this is a true pension plan, and because he's allowed to pension income split with a spouse, so that he only has to pay tax on half of it, and the other half is included in his spouse's tax return, what happens is both persons in the couple pay tax on a lower amount. And when you add the taxes that both parties have to pay, the couple ends up paying $36,400 annually on this $169,000 pension. Well, that's pretty good, because $36,400 is $18,000 less than what he would have paid had he not done the pension income splitting. So simply with this paper exercise of transferring half the value to the spouse's tax return, the couple is saving over $18,000 annually in taxes. And we have a comment at the bottom saying that's not too bad, given that the cost of running the program ranges from $1,000 to about $2,800, depending on the platform used. So you can see that this is really a money-making printing machine. So just to wrap up, really, we go back to our three questions. Do I want to pay less tax than 98% of Canadians are using the RSPs? Do I want to maximize my retirement income? We saw that the PPP is at the very top of the heap in terms of tax solutions. And do I want the tax refunds to pay for the cost of the program instead of coming out of my own pocket? We saw just with pension income splitting how much more money is kept by our clients. So I'm going to turn it over back to Viren for some final concluding remarks.
On behalf of Karma Financial and all our attendees, Jean-Pierre, I'd like to thank you for your time, for educating us on the personal pension plan. As you can see, the personal pension plan is a great innovative tool from a tax perspective and a retirement planning perspective. We found with all of our clients that they've actually received optimal tax benefits as compared to the more traditional means of RSPs and other forms of tax sheltered savings. If you are interested in exploring the personal pension plan, I encourage you to contact me ASAP. My contact information is as below. I can be found on LinkedIn. I also have my website, karmafinancial.ca, and my email is viren@karmafinancial.ca. I look forward to hearing from all of you, and thank you for attending today's session. This concludes our presentation, and thank you for attending.